Hey everyone, welcome back. Ready to dive into something that's relevant to, well, pretty much everyone listening. We're talking taxes.
Taxes.
Specifically, those intriguing little changes the IRS just announced for 2025.
Oh, yes. Deciphering tax code. It isn't exactly everyone's idea of a good time,
Right.
but understanding these adjustments could actually put some money back in your pocket next year. So let's break down what's different and what it means for you.
All right, so seaming through these notes, we've got standard deductions getting a boost, some shifting tax brackets, even a few tweaks to capital gains. Let's unpack this, shall we?
Let's do it.
Okay, first up, standard deductions. They're going up, which has got to be good news for most people, right?
Absolutely. You can think of it as the IRS giving you a little breathing room before they calculate what you owe. For most people, it's a simpler alternative to itemizing deductions, which can be a real headache.
Right, who has time to itemize every little thing. So how much of a boost are we talking about here?
Well, for those filing a single or married filing separately, the standard deduction is going up by $400, bringing it to a total of $15,000. And for those filing jointly as a married couple, you get double that, an extra $800, bringing your deduction to $30,000.
Okay, now we're talking. Those are some significant savings, especially for couples filing jointly. It's interesting, you mentioned this is simpler than itemizing, but about 90% of taxpayers already use the standard deduction, right?
That's right. It's generally the most beneficial option for the majority of taxpayers, and these new adjustments make it even more impactful.
Got it. So reading between the lines here, this bump in the standard deduction is tied to inflation, isn't it? Like everything else these days, the cost of living seems to be going nowhere but up.
You hit the nail on the head. The IRS adjusts these deductions annually to try and keep pace with inflation. Essentially, they are attempting to prevent what's called bracket creep.
Bracket creep. I've heard that term thrown around, but to be honest, I'm not entirely sure I understand it. Could you elaborate on that a bit?
Yeah, of course. Bracket creep happens when inflation pushes your income into a higher tax bracket, even if your actual purchasing power hasn't really changed. So you end up paying a larger percentage of your income in taxes, even though you're not any better off financially.
Oh, okay, that makes sense. And these adjustments to the standard deduction are meant to help mitigate that.
Exactly. The IRS is trying to maintain some sense of fairness, ensuring you're not penalized simply because the cost of, well, everything seems to be skyrocketing.
Okay, fairness from the IRS. I'll take it. Speaking of which, you mentioned tax brackets. Now, those always seem a bit more complicated. Break it down for me. What's changing there?
Sure thing. Just like those standard deductions, the income levels for each tax bracket are also getting tweaked for inflation. Again, aiming to combat that pesky bracket creep. This means the income thresholds for each tax bracket are increasing slightly.
So how significant are these shifts? Are we talking about a major overhaul or more like minor adjustments this time around?
Well, here's where things get interesting. This year, the IRS actually implemented the most modest adjustment to tax brackets in years, a mere 2.8%.
Wow, the smallest in years. That's got to be notable, right? What's the story there?
It is significant, and the reason is actually pretty straightforward. Inflation has been cooling off recently.
Oh, okay.
Remember those incredibly high inflation rates we saw in 2023 and 2024? Things have started to stabilize a bit, and this more moderate adjustment to the tax brackets reflects that.
Interesting. So these adjustments are a bit of a reflection of the broader economic picture.
Speaking of getting a bigger picture perspective,
Yeah.
you know what I find incredibly helpful when trying to wrap my head around these more complex topics?
What's that?
Podcasts, of course. I'm a huge podcast nerd. I'm always listening to something, whether it's news, finance, even true crime. But recently, I stumbled across something pretty amazing. Have you heard of podcastworld.io?
Podcastworld.io. It rings a bell. Isn't that the platform that lets you search through podcasts like a search engine? That's the one. It's honestly a game changer, especially for someone like me who's always on the hunt for insightful information. You can literally type in any question or topic, say, tax bracket changes, and it will pull up podcasts and episodes discussing exactly that.
That's right. I remember reading about it. It's not just finding episodes either. It actually pinpoints the exact moment they answer your question. No more scrubbing through hours of audio. And I think they even have AI bots of your favorite podcast hosts. Imagine that, asking a question directly.
Right. Honestly, it feels like the future of information consumption. I can even imagine using it to delve deeper into these tax changes, finding episodes with tax experts who can offer even more specific advice.
Absolutely. It's like having a personalized research assistant, but for podcasts. We'll have to remember to mention that again later. I'm sure our listeners would find that incredibly valuable.
Definitely. Okay, so before we got sidetracked by the wonders of the podcasting universe, we were in the thick of those tax bracket changes. You mentioned these brackets have shifted. So how would this impact someone, say, a teacher in a two-income household?
That's a great example. Let's say our hypothetical teacher and their partner are filing jointly, and their combined income falls somewhere between $50,000 and $100,000. This puts them squarely in the 12% tax bracket. Now, with the bracket adjustments, even a small shift in those income thresholds could result in a slightly smaller tax bill for them.
So even these seemingly small changes can actually make a difference for people.
Absolutely. Every little bit counts, especially in this economic climate.
I hear that. Okay, so we've covered standard deductions, tax brackets. What else is on the docket of changes?
Well, we can't forget about capital gains. This is one that's particularly relevant for our listeners who are investors.
Right, capital gains. That's the tax you pay on any profits you make from selling assets like stocks or real estate. So what's the news on that front? Any big changes for 2025?
Well, the good news is the actual capital gains tax rates themselves haven't changed.
Okay.
What has shifted, however, are those income thresholds we keep mentioning.
Right, those thresholds determine which tax rate applies to you. Kind of like those brackets we were talking about earlier. Can you refresh our memories on what those capital gains rates look like?
Absolutely. If you're a lower earning investor, you're still sitting pretty with a 0% tax rate on those long-term capital gains.
0%.
That's right, 0% on those profits.
Okay, now that's a deal I can get behind, but I'm
Exactly.
assuming there's a catch.
Ooh,
Those income thresholds.
exactly. To qualify for that sweet 0% rate in 2025, individuals can earn up to $48,350, and married couples filing jointly can earn up to $96,700.
So for those earning within those limits and making smart investment moves, congrats. You've hit the capital gains jackpot. What about those earning a bit more? Are they stuck with a hefty tax bill?
Not necessarily. For those above those thresholds, but below $533,400 for individuals, or $600,050 for married couples filing jointly, the long-term capital gains rate remains a very reasonable 15%.
15%, still not too bad. But this is where things can get a little tricky, right? Especially when you're dealing with investments in capital gains. There are a lot of nuances to consider.
Many.
It makes you wonder, are there specific strategies people can use to minimize their tax burden in these areas?
You're exactly right. This is where things move beyond general information and into the realm of personalized financial advice. There are absolutely strategies you can employ, but the best approach depends on your individual circumstances.
Makes sense. It makes you realize how valuable expert advice can be in these situations. Speaking of which, remember that platform we were discussing earlier? Podcastworld.io.
You mean the one that lets you search through countless podcasts for specific information? Of
Yeah.
course.
Well, imagine this. You're listening to our overview of these capital gains changes, and you have a super specific question about, say, real estate investment and capital gains taxes. Instead of just hoping we'll cover that specific niche, you could pause our episode right now, pop over to podcastworld.io, and type in real estate capital gains.
And it would pull up episodes from other podcasts, maybe even featuring tax professionals specializing in real estate who've discussed that very topic.
Exactly. You could create your own personalized deep dive into that specific area, all thanks to the magic of podcasting.
It's like having access to a curated library of knowledge, tailored to your exact questions and interests.
Right. Okay, so we've covered a lot of ground here. Standard deductions, tax brackets, capital gains. It's a lot to digest. Any final takeaways for our listeners as we wrap things up?
Absolutely. Remember, tax laws are constantly evolving, and what we've discussed today is just a starting point. The key takeaway is to stay informed, do your own research, explore resources like podcastworld.io to delve deeper into specific areas, and consult with a qualified tax professional for personalized advice.
Wise words. Knowledge is power, especially when it comes to navigating the sometimes complex world of taxes. Thanks for joining us on this deep dive into the 2025 tax changes. We'll see you next time for another insightful exploration.
See you next time.